This is Optimal Finance Daily, episode 467. Should I repay debt or invest? 7 Critical Things to Consider by Paula Pant of affordanything.com. And I am Dan, your host. A happy Hanukkah to those of you celebrating the start of the holiday today. I'm here each Monday through Friday reading to you from some of the best personal finance blogs on the planet. And if you've got some ideas for us, some topics you'd like to perhaps hear us cover, please share those over at oldpodcast.com. That's oldpodcast.com. And many of you who've been listening for a while already know this, but I want to let anybody who's new know that we give away books to random people on our mailing list. So if you want a chance to win, make sure you join. It's totally free to do it. All you have to do is enter your email address, and that is also over at oldpodcast.com. For now, let's get right to today's post and start optimizing your life. Should I repay debt or invest? 7 Critical Things to Consider by Paula Pant of affordanything.com. Today's letter comes from a 25-year-old reader named Chris, who asks, quote, invest for retirement or pay down debt? This may be more of a personal choice than anything, but I've been subscribed to the pay down your debt before you invest camp for about a year now. I should have my debt paid off by mid-2012 if I stick to that plan, but am I going to regret my year-and-a-half hiatus from retirement contribution? End quote. Repay debt or invest is a classic question, as timeless as chicken or egg and chocolate or vanilla. For those of you who haven't heard this question before, here's the background. One school of thought says repaying your debt should be your top priority no matter what. Debt psychologically traps you, and it guarantees you'll lose money to interest payments every month. Another school of thought advocates earning returns if there's a spread between your investment returns and your interest rate. If you earn 7% through investments and your interest rate is only 4%, then you're losing 3% in opportunity cost by repaying debt. These ideologies are arguing between risk and reward. The anti-debt camp focuses on your risk, the guaranteed loss of interest. The pro-invest camp focuses on the potential reward, the opportunity to multiply your gains. Both crowds agree that if you have credit card debt with a 20% interest rate, you should pay that off immediately, but they hold different reasons. The anti-debt crowd says you should repay your credit cards so you can stop losing money on interest. The pro-invest crowd believes you should repay that debt because you won't find a reasonable investment that pays more than 20%. Repay debt or invest. Which crowd is right? Personal finance is 90% behavioral psychology rather than math, so you'll need to make a personal choice. But here are a few things to consider. Number 1, retirement match. Does your boss offer a retirement match? If so, that's a guaranteed 50% or more return on each dollar that you contribute. You can't beat that rate. If your job offers a retirement contribution match, squeeze it for every penny you can get. Otherwise, you're passing up a chance to earn 50 cents or more on every dollar. Number 2, tax benefits. I'm the last person who will advise you to do something for tax reasons. Do something only if it's a good idea. The tax benefit is icing on the cake. That said, if you're young and in a low tax bracket, investing in a Roth IRA could be a huge win. You'll pay taxes on that income now at your current low tax rate and never pay a dime in taxes again, not even on dividends and capital gains. That's huge. If the interest rate on your debt is low enough, you might want to jump at the chance to waive dividend and capital gains taxes for the rest of your life. Number 3, your interest rate. The higher the interest rate on your debt, the harder it is to justify holding that loan. But how high is too high? Historically, the U.S. stock market has returned 9% over the long term. Warren Buffett predicts that the market will return roughly 7% in the coming decades. In both cases, we're discussing long-term averages. In the short term, 1 to 5 years, the market could stagnate or collapse. Number 4, dividend payouts. A safer way to invest would be to look at the return you can earn from dividend payouts. Here's how you calculate this. 1 share from the McDonald's Corporation trades at $98. McDonald's offers a dividend payment of 70 cents per quarter, or $2.80 per year. This means that you'll get $2.80 per year for each share of McDonald's stock you own, regardless of whether the stock price goes up or down. So what kind of return is that? Well, take the yearly dividend payment, $2.80, divide it by the price at which you buy the stock, $98, and multiply the result by 100. 2.8 over 98 times 100 equals 2.85%. So you'll earn a 2.8% return from the dividend on this stock. In January 2011, McDonald's was trading at $74 a share. If you had bought shares at that time, your dividend return would be 3.7%. The fact that the stock also grew by $24 a share is just icing on the cake. That's why an essential truth about investing is that you make money when you buy, not when you sell. As a general rule of thumb, you could collect about 3.5 to 4% in dividend returns if you target your money toward high dividend stocks in today's market. Don't wade into this field unless you're prepared to handle the volatility in the underlying value. Side note, the best way to handle this is to ignore it. Remember, stock price is purely theoretical unless you're buying or selling. Number 5, rental properties. I can't say enough good things about these. Buy properties with positive cash flow. This is a perfect example of the positive power of debt. Number 6, launching your own business. On one hand, small business loans are tough to get, and the interest rates are higher than, say, the rates on a student loan. On the other hand, small business is incredibly risky. It might be the next Subway or Facebook or Pepsi, or it might fall flat on its face. In my family's business, we've avoided taking business loans unless we need upfront capital to fund a project we've been awarded. In other words, we avoid loans unless we have IOUs to match. Number 7, inflation. Everyone seems to forget this critical piece of the puzzle. If you hold debt, inflation is your best friend. Why? Here's how it works. Let's say your mortgage is $1,400 per month. This is a fixed rate payment. It will never change. In 2012, that amount, $1,400, has a certain amount of purchasing power. It can buy a round-trip ticket from New York to Cape Town. It can buy 1/3 of a Louis Vuitton handbag. But 30 years from now, that same $1,400 will buy a box of saltine crackers and Cheese Whiz. I'm exaggerating, of course, but you get my point. Inflation will erode that money's purchasing power. You repay your mortgage and other debts with cheaper dollars over time. Inflation tends to average about 3% per year. If the interest on your debt is low, 4 to 5%, you may consider hanging on to that debt. Of course, if deflation strikes, you're screwed. Final thoughts. Don't assume that debt repayment is risk-free. Both options carry risk. Opportunity cost is expensive. You'll never remove risk. You can only pick the type of risk you prefer. You just listened to the post titled, Should I Repay Debt or Invest? 7 Critical Things to Consider by Paula Pant of affordanything.com. And once again, if you want to have a chance to win a book from us, all you have to do is make sure you're on our mailing list at oldpodcast.com. You'll also get some free financial spreadsheets from us, including one that shows you when you can retire, as well as a video tutorial, a weekly email with life tips, quotes, and more. So for all of that, come join our weekly newsletter mailing list at oldpodcast.com. And that's it for our show today. Thanks as always for listening. Have a great rest of your day, and I'll see you tomorrow where your optimal life awaits.
Hello, Life Optimizer. This is Justin Malik, creator and producer of this podcast, but also Optimal Living Daily, the show where I read to you from even more blogs covering finance, productivity, minimalism, personal development, and more from incredible bloggers like Derek Sivers, Zen Habits, Mark and Angel, The Minimalists, and all the ones you hear on this show too. So if you enjoyed today's episode and like taking amazing blogs on the go, come on over to Optimal Living Daily and subscribe to that one too. And together, we'll start optimizing your life.
You've been listening to Optimal Finance Daily. Be sure to hit the subscribe button to stay up to date on each new episode and head to oldpodcast.com. That's OLDpodcast.com for a free gift as well as more actionable tips and resources to help you maximize your potential. Thanks for joining us, and remember, your optimal life awaits.